Hi, and welcome to Retirement Answers today. My name is Jim Martin. I'm your host on this journey called retirement. And we are talking today about the Federal Reserve, interest rates, and what it means to you. Because I know if you're like many people that we talk to, you have questions. I'm joined by Sam Benson. Sam is a financial advisor at Martin Wealth Solutions. Sam, how are you today, sir?
Jim, I'm doing great. Hope you are.
I am. Thanks for joining us, being part of this conversation. I know this is a big one that's out there right now. If you haven't realized the Fed is raising rates pretty aggressively, you've been under a rock. What you think?
I would agree.
That might be a good place to be sometimes in these kind of environments where the market's a little volatile and the interest is or inflation's high and the Fed's raising rates. So that might be ignorance sometimes is bliss in a lot of cases. But look, if you've got money in investments and you have savings and you've been paying attention, you're probably have some questions. You might even be worried. So what I'd like to do, Sam, is kind of just jump right in. Why in the world? Why did the Fed raise rates? Like what's the core of that? So let's talk about that. Why do you think the Fed raises rates, sir?
Well, in the present context of the situation we're faced with, the Fed has multiple mandates, and sometimes those are contradictory. But right now, what they're trying to do is combat inflation. There's been a long policy here over the last several years of extremely cheap money, possibly too cheap. That's created excess demand. COVID then came in, created supply chain disruptions. And then over and above that, we've had sort of a glut of congressional spending as well. And all of this has had the effect of driving inflation up. You've got too many dollars chasing too few goods. Prices are going through the roof, and now it's problematic. It's the highest inflation rate we've seen in 4 decades. So the Fed is stepping in now to make money essentially more expensive to borrow. And the purpose of doing that is to have a net effect of reducing the money supply. Fewer dollars chasing that same amount of goods and services should have the effect of bringing prices down. That's the thinking.
That's the theory. And the wild card out there is inflation is not just a United States phenomenon right now. It is
it's global.
It's global phenomenon. And one of the things what's helping drive that inflation around the world is, well, first off, the U.S. economy is, where the U.S. economy goes, the world goes. And then we've got Russia and Ukraine duking it out right now. And that's causing supply chain disruptions in Europe as well. So that's causing this cascading effect where we just have high inflation. And the Fed really doesn't have a lot of tools in its tool belt to fight inflation. I mean, there's really no magic bullet. This inflation is really a supply demand driven idea. And essentially you raise rates to reduce the money supply, to make it more expensive to borrow. And, it has impact. Like if you're going to go get a mortgage today, is the mortgage more or less expensive than it was just 6 months ago? But
it's significantly higher.
Right. Like you could have gotten a 30-year mortgage for 3%. It's 5.25% now or 5.5%. And I don't know about you, but that's a lot more in interest that people have to pay. So what's that done to the real estate market already? It's cooled it down a bit. So yeah. So we're starting to see things. What are some other things out there that we're beginning? Have you seen any effect yet from the Federal Reserve raising rates, or is anything slowing down in your estimation?
Well, yeah, I mean, the first thing, and the stock market is always forward looking. It's more of a barometer than a thermometer. In other words, it's looking at where the weather is coming from, not what it's doing today. So we've seen stock prices fall fairly precipitously over the first half of this year. We've had a pretty big drop in stock valuations. And the reason for that is because the market's looking around and saying, as interest rates go up, companies that have to borrow, it's going to cost them more to do so. That's going to have an effect on corporate profitability. And the same thing is true for the consumer, as it costs us more in a consumer-driven environment to buy things. And as inflation increases and we pull back on spending, that also makes a projection on the stock market. And we've seen very predictably that the more debt-driven companies, the growth stocks, especially the tech stocks, we've seen their prices come down more than, say, some of the more stable valuation consumer staples type of stocks. And that's what we would expect to see. And the other impact that we've seen from this is the effect on bond rates.
Yeah, definitely. Yeah, and we're going to get to what does this mean for savers and investors in a moment. That's a good kind of tee up for that. And I just think that if you're a consumer, just understand that the Federal Reserve is raising rates to tamp down inflation, and they're following the same model that Paul Volcker did back in the 80s. And if you've been around for that, you remember how high interest rates got. You could go down to your local bank and get a 12, 13, 14% CD. Of course, if you bought a house, guess what you were paying?
You were also getting a 13% mortgage.
Yeah. Lots of people remember those mortgages back from the early 80s. And inflation is not a good thing. We don't want inflation to run that high because it essentially prices everybody out of everything. Inflation is it is the wealth killer of all wealth killers. And unfortunately, it doesn't affect the wealthy as much as it affects the poor. And, if you've seen your price on gasoline and food go up by 20 or 30% and your wages haven't kept pace with that, it's really impactful. So it's in everybody's best interest that we take our medicine and watch the Federal Reserve do their best to get rates under control. And we're likely to see some more rate increases through the rest of the year, but we might see some slowdown as well as they kind of wait to see what the impact has been of their rate increases. So it's really they're really walking a tightrope here of trying to Sam's point, manage a couple mandates, which is number one, get inflation under control, and then number two, keep unemployment at a low level. So it's going to be an interesting second half of the year as they manage through this. But I think there's already some positive signs. Like we've seen gas prices come down a bit. A lot of groups, we've seen the stock market drop. Walmart has said that people are shopping less. So we're starting to see that demand side of the equation right size a little bit. Now, if the supply chain can catch up, that'll be a big deal. Let's talk about let's pivot, because I think we know why the Fed now raises rates. Let's talk about what it means for savers, because the good news with a rate increase, if you want to call it that, is we're starting to see rates go up on CDs and money markets and maybe even savings accounts. And I don't know about you, Sam, but that's pretty exciting for some of our clients and some people we've run into. Have you heard a little excitement out there in the world?
A lot, and it's really picked up, not so much in the early part of the Fed's rate increases, but since the July rate increase, we've started to see a lot of demand for that because, despite the specter of inflation that's out there where it's, nominally at 9%, suddenly you can get a fixed income instrument like a CD or like a fixed annuity or a money market that's suddenly paying yields like we haven't seen in 4 or 5 years or longer. And for people who don't want to risk their money, who are more interested in protection, and just keeping up as opposed to growth, that can be very attractive.
Sure can. Yeah, and look, let's be really clear. I know people are really excited. All of a sudden, they can go online and go to Marcus or Ally or wherever and get a 1.4% yield on their CDs or not CDs, but money market or savings. And that feels really good until you realize that inflation, if it's running it at 9%, you're losing purchasing power. So I would encourage our savers out there to understand that yes, savings rates are higher. And I know that's really exciting to see it move from 0.4 or 0.25 up to 1.4 in less than 6 months. But remember, you are losing money to inflation in a big way, losing purchasing power if you're not keeping up with it. So I think to Sam's point, you've got to really be deliberate about looking for opportunities, some of those instruments, whether those are CDs or fixed annuities or some bonds potentially. I mean, I've seen treasury yields get pretty good here recently too. There are some really good opportunities out there in a relative sense as opposed to where we were before. And they're not paying 9%. I want to make sure I'm really clear. Like that doesn't really exist. But what they do is they're a much better yield than that 1.5%. So if you're a saver, if you want to be a good steward of your dollars, I would really encourage you to go out and really shop the yield place or the yield marketplace, because every percentage point really counts in an inflationary environment. It's a big deal. And, savers, they've got it pretty easy because they can look at rates. Investors, though, they've been pushed around a little bit this year. Markets moving up and down. And, we've seen recently a little bit of a recovery in the market, but boy, it really fell off the cliff in the first part of the year. So why is that, Sam? Why do you think the market reacted the way it did to the Fed rate increases?
Well, I think it comes back to what I said earlier. On the stock side of the market, it's simply going to be, it's anticipating that it's going to be a slowing of the economy. Corporate issues will pull back, the profitability will fall. And on the fixed income side, if I buy a bond yesterday that is paying me 1%, and 6 months later, that same type of bond is now a 2.5% or 3% bond, the price of the one that I bought yesterday has to fall in a marketplace to keep up with that. As rates increase, existing bond prices fall. And I think that's one of the things that's really surprised investors in this bear cycle that we're in, is that, it's not a situation where stocks fall and bonds have acted as a balance in a portfolio or a ballast. They've fallen along with that. And that's because of the severity and accelerated pace of these rate hikes. And that's what the market's looking at.
Yeah, I think you're spot on. The market realizes when the Federal Reserve raises rates, they're going to slow down the economy. And remember, the markets really care about two things. They care about the two P's, I like to call them: profits, how much are you making today, and potential, how much do you have to make in the future. And if you raise rates, think about that. Their cost of borrowing goes up. The consumer is impacted, and all of a sudden, maybe the demand for their product or service is decreased. Now, there are pockets of the market that have done very well through this cycle, but there's also pockets of the market who, Sam's point earlier around tech companies, have really seen a lot of impact because they borrow a lot of money, or they're operating at pretty thin margins, or their consumers, they're more discretionary in nature. At the end of the day, if things are tight, you probably don't need an iPhone 13. You can probably hang on to your iPhone 11 for a few more months, or maybe you don't need to go get a new car. You can hold on to yours for another 10,000 miles. So we've seen some of those discretionary areas really take a hard look at that, and we've seen that. We've really seen that with some of the major retailers as well, because as the consumer potentially is geared up to spend less, it's been impactful. With all of that said, let's really face the facts. Inflation's resolved itself before. We've been here before, right? We're after the period where inflation was under control in the 80s. Sam, what happened to the market?
It took off. The growth rate, both, at the economic level in terms of GDP growth and the growth of the major indices, the Dow Jones, the S&P, whichever one you want to look at, they took off like a rocket for the next 8 or 9 years running. And the next recession that followed that, it was actually fairly mild as well. So, when the adults in the room step in an inflationary environment and do what is necessary, as the central banks are doing now, when they step in to correct for this, it's going to be painful. There's potential for recession. Anybody that's studied the history of the last high inflationary period knows what happened from 1981 to 83. It wasn't fun, but you're in a much better position to come out of things on the other side. And the other upside is that, with a higher base rate level, you talk about the arrows in the quiver that the Fed has, that gives them a little bit of wiggle room to come down later on interest rates, which is going to have a positive effect on the markets and the economy.
Yeah, should they need to, they have some ammunition. So that I think that's really good news. Yeah, I think the important thing for investors to realize are rates are priced into the market. That's why the Fed minutes, the Fed meetings are so carefully picked over. I mean, it's like the Super Bowl on CNBC when they announce these things. But the reality is the market's pricing this stuff out. They're gonna price in the profits of the most recent quarter. They're gonna take a look at the potential, and they're gonna index that for the inflation and interest rate potential hikes that are out there. And I think there's some opportunity for investors. We don't know where the market's going to go, and we don't make predictions in our world, but I do know that when the markets go down, things are on sale. And I don't know about you guys, but I like to look at opportunities that are on sale. If I go shopping, I want to go and buy things that are not full price. I want them on sale. And you could use that same kind of wisdom where the market is today and look for those opportunities to do better going forward. And I think that's really important for investors to realize, well, we might see some more inflationary numbers and all these things. Remember, it's already priced in. That's why we saw the decline. And it doesn't mean we're not going to have more pressure on the market. I want to make sure I'm really clear. We just don't know. But I think times like these are really favor long-term investors. The short-term investor, they're panicked right now. But look, if you're in it for a long term, I'm always optimistic. I feel like if you can wait this out, things will turn around. At least they always have. I would encourage investors at home to take a long-term approach. That doesn't mean where you're at is perfect. That doesn't mean you shouldn't review your portfolios. Doesn't mean you shouldn't review your cash holdings. Doesn't mean you shouldn't adjust your risk tolerance or your investments. But it just means don't make these knee-jerk reactions to it. Remember, the Federal Reserve is raising rates to lower the money supply, to slow down inflation by tamping down demand. It's going to impact savers because interest rates are going to go up, but you have to be very mindful that you need to get the very best savings rate on your money. And then last but not least, it definitely will impact the investors out there because the market's going to price this stuff in. But the good news is after it's priced in, guess what? It's priced in. So the only thing we have to wait for now is when does that rocket take off, that proverbial rocket Sam alluded to? We don't know when or if, but we suspect that it will based upon historical numbers. So remember, investing is a long-term endeavor. And I would encourage, I'd encourage our people out there to really take that into consideration. Sam, any last words for our listeners today?
Yeah, I think, to your point about it being a long-term endeavor, your investment career as an investor, it's like taking a road trip from New York to Los Angeles. There's going to be detours. There's going to be traffic jams. There's going to be highways that are shut down. You might have a flat tire. All these things are going to take place. And you've got to keep the long-term end journey in mind. If you're adequately diversified, if you're buying quality, if you're buying, as you said, Jim, when things are on sale, you're far more likely to have positive outcomes than, getting out of your car and walking just because you're in that traffic jam. So I think that's something to remember.
I like the way you put that. You do not want to get, I have seen enough of these movies before where you do not want to get out of your car and walk. No, it does not work. Hey, I want to thank everybody for listening to the podcast today. Hopefully this information was useful. We're going to monitor the Fed, and if we think we need to have additional information or shows on this, we certainly will. Remember, plan well and retire awesome. As we wrap things up today, I want to invite you to visit our website, retirementanswerstoday.com. I also need to review with you the things I have to disclose as a financial advisor offering wealth management services through my firm, Martin Wealth Solutions. You should know that the opinions I discuss here are my own, and like the weather, they can change. The content I provide in the show is for general education purposes only. It's not meant or intended as specific advice, nor do I recommend any special financial products or strategies. You need to talk to a professional before taking action. I can't guarantee that my statements, opinions, or forecasts are always right. Past performance is not indicative of future results. I'm not an attorney, thank God, or a tax professional. And remember, all investing involves risk, including the loss of principal. There is no guarantee that any investment or plan will be successful. See you next week.